People always ask me, Larry, what's the secret to BlackRock's success? What's the investment strategy that built an $11 trillion firm? And they expect me to reveal some sophisticated trading algorithm, some proprietary market insight, some genius stock-picking formula that only we know. But that's not the answer, and honestly, that's never been the answer. The truth is far less exciting and far more powerful. BlackRock didn't become the largest asset manager in the world because we're smarter than everyone else. We didn't get here by making perfect predictions or timing markets flawlessly. We got here through habits, daily habits, boring, unsexy, repeatable habits that compound over decades the same way investment returns compound. I wake up at 5 a.m. every single morning. I've been doing it for 50 years. I spend 1 hour every day studying markets and learning. Even now, at 72 years old, I'm still a student. I review my portfolio and strategy every quarter without fail. January, April, July, October. Non-negotiable. I've automated every decision I can automate, removing emotion from the equation. And I protect my health and balance like they're the most valuable assets I own. Because they are. These aren't secrets. They're not complex. They're actually quite simple. But simple doesn't mean easy. And that's why most people don't do them. Today I'm going to share the 5 habits that built BlackRock. The same 5 habits that have guided my 50-year career. The same 5 habits that work whether you're managing $11 trillion or $11,000. Because here's what I've learned. Discipline beats brilliance. Systems beat willpower. Consistency beats intensity. Every single time. Let's get into it. Before we dive into the specific habits, I want to frame this properly. When most people think about investing success, they think about what to buy, which stocks, which funds, which sectors. And yes, those decisions matter. But there may be 20% of the equation. The other 80%? That's behavior. That's discipline. That's having systems and habits that prevent you from making catastrophic mistakes. I've seen brilliant people, PhDs in mathematics, former traders, successful business owners, completely destroy their portfolios because they lacked discipline. They panicked during crashes. They chased performance. They abandoned their strategy at exactly the wrong time. And I've seen ordinary people, teachers, small business owners, people with no financial background, build substantial wealth because they had simple habits and they stuck to them. The difference isn't intelligence, it's discipline. Now, here's what's important about the 5 habits I'm going to share. They're not just for professional investors. They're not just for people managing billions of dollars. These habits work at any scale. They work for someone starting with $1,000 as much as they work for institutions with billions. Why? Because they address the universal challenges of investing: emotion, inconsistency, lack of preparation, reactive decision-making. The 5 habits are: Habit 1. Start your day before the market does. Take control of your morning. Habit 2. Dedicate 1 hour daily to continuous learning. Stay a student forever. Habit 3. Conduct quarterly reviews and rebalance systematically. Make discipline automatic. Habit 4. Automate every decision you can. Remove emotion from the process. Habit 5. Protect your health and maintain balance. Investing is a marathon, not a sprint. These 5 habits create a framework, a system, a way of operating that makes good decisions inevitable and bad decisions nearly impossible. Let's start with habit number 1. Habit number 1. Start your day before the market does. I wake up at 5 a.m. every single morning, 7 days a week, holidays included. Now, before you think I'm some kind of superhuman or that I'm preaching some hustle culture nonsense, let me be clear. This isn't about working more hours. This isn't about sacrifice or grinding. This is about control. When you wake up early, before the world makes demands on you, you control your morning. You're not reactive, you're proactive. You're not responding to emails and phone calls and urgent requests. You're preparing. You're thinking. You're setting intentions. Let me walk you through my morning, and then I'll show you how you can adapt this to your life. 5 a.m. I wake up. First thing, and this is critical, I don't check my phone. Not email, not news, not messages. Nothing. Why? Because the moment you look at your phone, you're in reactive mode. You're responding to other people's priorities, other people's urgencies, other people's agendas. Instead, I start with myself. 5 to 5:15, I hydrate. I splash cold water on my face. I get present. I think about the day ahead, not in detail, just broadly. What's important today? What matters? 5:15 to 6:15. Exercise. 1 full hour. Every day. For me, it's a combination of cardio and strength training. Nothing fancy. I'm not training for a marathon. I'm maintaining cardiovascular health, bone density, mental clarity. And here's what most people don't understand. Exercise isn't just about physical health. It's about cognitive function. It's about stress management. It's about decision-making quality. There's extensive research on this. Exercise before work improves executive function, the cognitive abilities you need for complex decisions. It reduces anxiety. It improves creativity. It builds stress resilience. As an investor, you need all of those things. When markets are volatile and everyone's panicking, the person who exercised that morning is more likely to stay calm and make rational decisions. The person who rolled out of bed and went straight to their screen, they're operating on cortisol and fear. 6:15 to 7, breakfast and information intake. I have a nutritious breakfast, nothing elaborate, just good fuel, and while I eat, I read. The Wall Street Journal, the Financial Times, the New York Times, Bloomberg. I'm scanning headlines, reading key stories, staying informed about global events and market conditions. I'm not trying to predict what the market will do today based on overnight news. That's pointless. I'm building context. I'm staying aware of the forces shaping the world. By 7 a.m., I'm at my desk. The market doesn't open until 9:30 Eastern, but I've already had 2 productive hours. I've exercised, I've read, I've thought. I'm prepared. And that preparation gives me a massive edge. Now, how do you implement this in your life? You don't need to wake up at 5 a.m. That's my schedule. Yours might be different. But here's the principle. Start your day before the market starts, before the chaos begins, before everyone else is demanding your attention. If you have a job that starts at 9 a.m., maybe you wake up at 6:30 or 7. That gives you 90 minutes to 2 hours. If you're not a morning person, fine. But then structure your evening. Before bed, spend 30 minutes preparing for the next day. Review what happened in markets. Set intentions. Create a plan. The specific time doesn't matter as much as the principle. Control your preparation time. Don't let the day happen to you. Prepare for it. And here's what I recommend as a minimum routine. 20 to 30 minutes. Physical movement. Walk, stretch, light exercise. Get your body moving. 20 to 30 minutes. Information intake. Read financial news. Understand context. 10 to 15 minutes. Review and intention setting. What's important today? What decisions need to be made? What am I watching? That's it. 60 minutes total. 1 hour of proactive preparation that makes the rest of your day infinitely more effective. I've been doing this for 50 years, and I can tell you with absolute certainty, this habit alone, starting your day before the market does, will make you a better investor. Not because you'll have some information advantage, but because you'll be calm, prepared, and thinking clearly when everyone else is reactive and emotional. That's habit number 1. Habit number 2. Dedicate 1 hour every day to continuous learning. I've said this publicly many times, and people are often shocked by it. I'm 72 years old. I've been in finance for 50 years. I run the largest asset management firm in the world. And I still spend an hour every single day learning. Every day, without exception. I'm still reading books. I'm still studying research papers. I'm still trying to understand new technologies, new market dynamics, new investment approaches. I am still a student. And if I've learned one thing in 50 years, it's this. The moment you think you know everything, you're finished. The market will humble you. The world will change around you, and you'll be left behind. Let me be specific about what this learning hour looks like, because it's not random. Part of that hour is staying current. What's happening in markets today? What are central banks doing? What are governments doing? What are the major economic trends? I read research reports from our teams at BlackRock. I read analysis from other firms, including our competitors, because smart people work everywhere. I read economic data releases. I'm constantly updating my mental model of how the world works. Part of that hour is going deeper, reading books, academic papers, historical case studies, things that give me perspective beyond today's news cycle. I love reading about history, about previous market cycles, about how other investors approached similar challenges during different eras. There's so much wisdom in the past if you're willing to study it. One of my favorite books is Benjamin Graham's The Intelligent Investor. I've read it multiple times over the years, and every time I find something new, some insight I missed before, some principle that's even more relevant today than when I first encountered it. Graham teaches patience, discipline, long-term thinking. These are timeless lessons. They worked in 1949 when he wrote the book. They worked in 1976 when I started my career. They work today. I also read books outside of finance: history, philosophy, science, psychology. Why? Because investing isn't just about numbers. It's about understanding human behavior. It's about understanding systems. It's about understanding how the world works. Team of Rivals by Doris Kearns Goodwin taught me about leadership and bringing together diverse perspectives, critical for managing BlackRock. Sapiens by Yuval Noah Harari gave me perspective on human society, on how we create collective fictions like money and corporations and nations. That philosophical framework helps me think about markets differently. Part of that hour is reflection. What did I learn yesterday? What decisions did I make? What worked? What didn't work? What would I do differently? I keep a journal. Nothing elaborate, just notes, observations, patterns I'm seeing, mistakes I want to avoid. This reflection practice is incredibly valuable because it turns experience into learning. Most people just accumulate experiences. They make the same mistakes over and over because they're not reflecting, they're not analyzing, they're not extracting lessons. Now, here's how you implement this habit practically. Block 1 hour on your calendar every single day. Treat it like a meeting you can't miss, because it is a meeting with yourself to get better. And be strategic about what you learn. Don't just read random articles about hot stocks. That's entertainment, not education. Instead, focus on 3 areas. First, fundamental knowledge. If you don't understand how bonds work, study bonds. If you don't understand options, study options. If you don't understand how inflation affects different asset classes, study that. Build a deep foundation of financial literacy. This is the bedrock everything else rests on. And here's the thing. You don't need to learn everything at once. Learn one topic at a time. Master it. Then move to the next. Over a year, if you study one topic per month, that's 12 topics. Over 5 years, that's 60 topics. You'll know more than 95% of investors. Second, current analysis. What's happening in markets right now? What are smart people saying about it? Read diverse perspectives. Read bulls and bears. Read optimists and pessimists. Read people you agree with and people you disagree with. Synthesize. Form your own view. Don't let one source shape your thinking. Third, historical perspective. Study previous bull markets and bear markets. Study previous recessions and recoveries. Study the dot-com bubble of 2000. Study the financial crisis of 2008. Study the 1970s stagflation. Study the 1987 crash. History doesn't repeat exactly, but it rhymes. And the patterns you learn from history will serve you for decades. At BlackRock, we invest heavily in education. We have training programs for our employees. We have knowledge-sharing sessions. We have a culture of continuous learning. Why? Because we know that in a rapidly changing world, the only sustainable competitive advantage is the ability to learn faster than the competition. The same is true for you as an individual investor. You're competing for returns with some of the smartest people in the world. Institutions with massive resources, PhDs, supercomputers. How do you compete? You can't outspend them, you can't outtrade them, but you can outlearn them in your specific niche. You can understand your investments better. You can be more disciplined. You can make fewer mistakes. And that comes from daily learning, from making it a habit, from treating it as non-negotiable. Here's something else I do. I meet with people smarter than me. I have conversations with economists, with technologists, with academics, with entrepreneurs. I'm constantly exposing myself to new ideas, new perspectives, new ways of thinking, and you should too. Join an investment club, find a mentor, connect with other investors online, have conversations, challenge your assumptions. Get your ideas stress-tested by people who think differently. Because investing is humbling. The market will humble you. The world will surprise you. Things you thought were certain will turn out to be wrong. And if you're not learning, if you're not adapting, you're going to struggle. But if you commit to learning every single day, if you make it a habit, you're going to get better. Slowly, steadily. And over decades, that compounding improvement leads to extraordinary results. 1 hour a day. That's 365 hours a year. Over 10 years, that's 3,650 hours of learning. That's the equivalent of multiple graduate degrees. And you can do it without quitting your job, without going into debt, just by committing 1 hour every day. That's habit number 2, continuous learning. Stay a student forever. Habit number 3, conduct quarterly reviews and rebalance systematically. This is where discipline really separates successful long-term investors from everyone else. Most people set up their portfolios and then ignore them. They buy some stocks, maybe some mutual funds or ETFs, and then they don't look at them for years. And they think that's long-term investing. They think that's being patient. But that's not patience. That's neglect. And neglect is expensive. Here's what happens. You set up a balanced portfolio. Let's say 50% stocks, 30% bonds, 20% alternatives. That's your target allocation based on your risk tolerance and financial goals. But then the markets do what markets do. They move. In 2025, stocks returned 17%, but international stocks returned 33%. Gold returned 65%. Bonds returned 8%. Those different returns cause your allocation to drift. If you started 2025 with a 50-30-20 portfolio and never touched it, by the end of the year, you're probably sitting at something like 54-28-18, or even more imbalanced. You're now more aggressive than you intended. You're taking more risk than you're comfortable with. And if you don't rebalance, that drift continues. Maybe stocks become 60% of your portfolio, then 65%, then 70%. And when the inevitable correction comes, you get hit way harder than you expected. You panic, you sell, you lock in losses. That's why systematic rebalancing matters. At BlackRock, we manage over $11 trillion, and we have systematic rebalancing processes for every single portfolio. It's not optional. It's not based on feelings or hunches. It's rule-based. When allocations drift by a certain amount, typically 5 percentage points, we rebalance. Period. No emotion, no debate, just execution. And that discipline is one of the reasons we've been successful for decades. Now, how often should you rebalance? I recommend quarterly, every 3 months. January, April, July, October. Why quarterly? Because it's frequent enough to prevent dangerous imbalances from building up, but not so frequent that you're chasing every market move and generating unnecessary costs. Monthly rebalancing is probably too often. You'll trigger unnecessary trades, unnecessary taxes, and you'll be reacting to noise rather than meaningful drift. Annual rebalancing might not be frequent enough. A lot can change in a year. You could let dangerous imbalances accumulate. Quarterly is the sweet spot. And rebalancing isn't the only thing you should do quarterly. You should also review your overall financial situation. Has anything changed? Did you get a raise? Did you have a major expense? Did your goals change? Did your risk tolerance change? Your investment strategy should evolve as your life evolves. And you should review your individual holdings, not obsessively, not trying to time every position, but making sure your investment thesis is still intact. When you bought an investment, you had a reason. You believed something would happen. You had a thesis. Every quarter, go back to that thesis. Is it still valid? Has anything fundamental changed? Has the competitive landscape shifted? Has management changed? If the thesis is still intact, hold or even add to the position. If the thesis has broken, if the reason you bought no longer applies, sell and move on. At BlackRock, we have investment committees that meet regularly to review holdings. We have analysts who monitor companies and sectors constantly. We have risk teams that assess portfolio exposures. It's a systematic process designed to catch problems early, to adjust when conditions change, to stay disciplined. You need your own version of this. Even if it's simple, even if it's just you reviewing a spreadsheet every 3 months. The discipline of regular review is what separates professionals from amateurs. Here's another thing I do quarterly. I review my cash position. How much liquidity do I have? How much dry powder for opportunities? If markets have been strong, I might be underweight cash, and I want to build it back up. If markets have sold off, I might have deployed cash, and I want to replenish it. Cash isn't dead money sitting idle. It's optionality. It's opportunity. When markets panic, when fear is high, when good assets are on sale, you want to have cash ready. But you only have that cash if you've been disciplined about maintaining it. I also review my tax situation quarterly. Am I sitting on big capital gains that I should be thinking about? Are there losses I can harvest to offset gains? Can I make moves that improve my tax efficiency? Taxes are one of the biggest drags on investment returns, and most people ignore them until April, when it's too late. Now, let me talk about the emotional benefit of quarterly reviews. When you review regularly, you're less likely to panic during crises. Why? Because you're engaged. You're not ignoring your portfolio and then suddenly checking during a market crash and freaking out. You've been monitoring. You understand what's happening. You're prepared. Quarterly reviews also help you avoid recency bias, the tendency to think that whatever just happened will keep happening. When markets are up, it's easy to think they'll keep going up forever. When markets are down, it's easy to think they'll never recover. But when you review quarterly, you see the cycles. You see that markets go up and down. You see that volatility is normal, and you maintain perspective. I'll be honest with you, the quarterly review habit is not exciting. It's work. It takes a few hours 4 times a year, but those few hours are some of the most valuable time you'll spend. They keep you on track. They prevent small mistakes from becoming big disasters. They ensure your portfolio stays aligned with your goals. So here's my challenge to you. Schedule your quarterly reviews right now. Pull out your calendar. Mark 4 dates: mid-January, mid-April, mid-July, mid-October. Block 3 hours for each one. Make them non-negotiable. Treat them like you'd treat a meeting with your most important client. Because you are your most important client. And when the time comes, do the review. Don't skip it. Don't postpone it. Just do it. Review your allocations. Rebalance if needed. Review your holdings. Check your cash position. Think about taxes. Update your plan if circumstances have changed. And document it. Write down what you did and why. So 3 months later, you can look back and track your progress. That's habit number 3. Quarterly reviews and systematic rebalancing. Discipline made automatic. Habit number 4, and this might be the most powerful of all. Automate every decision you can. Remove emotion from the process. Here's what I know after 50 years in this business. The biggest mistakes investors make are emotional mistakes. They buy when they're excited, when markets are roaring and everyone's euphoric. They sell when they're scared, when markets are crashing and panic is everywhere. They chase performance. They abandon strategies at the worst possible times. They let fear and greed dictate decisions. And all of these emotional reactions destroy wealth. So how do you fight emotion? You don't. You can't. Emotion is part of being human. You can't think your way out of fear during a crisis. You can't logic your way out of excitement during a boom. What you do instead is build systems that remove emotion from decision-making. You automate. Let me give you specific examples. First, dollar cost averaging. This is the practice of investing a fixed amount at regular intervals, regardless of what the market is doing. Every month, same day, same amount, same investments. Market up, you buy. Market down, you buy. Boom or bust, doesn't matter. You're buying consistently over time. Why is this powerful? Because it removes the timing decision. You're not trying to figure out if now is a good time to invest. You're not agonizing over whether markets are too high or too low. You're not second-guessing yourself. You've made the decision once to invest monthly, and then you just execute. No emotion, no drama, just consistency. And over time, this averages out your purchase price. Sometimes you buy when prices are high, sometimes when they're low. But on average, you get a fair price. And you're always invested, always participating in long-term growth. At BlackRock, when we advise individual investors, especially younger people building wealth, we almost always recommend automatic investment plans. Set it up once, let it run. Don't think about it. Let the system work for you. Second, automatic rebalancing. Remember habit 3, where I talked about quarterly reviews and rebalancing? You can automate parts of that. Many brokerage platforms now offer automatic rebalancing. You set your target allocations, 50% stocks, 30% bonds, 20% alternatives, and the system automatically rebalances for you when allocations drift beyond a threshold you define. No emotion, no procrastination, just systematic adherence to your plan. Is this perfect? No. Sometimes you might want to override the system based on specific circumstances. But for most people, most of the time, automatic rebalancing is better than the alternative, which is no rebalancing at all. Third, rules-based selling. One of the hardest decisions in investing is when to sell. People get attached to their holdings. They remember what they paid. They hope for recovery if they're down. They get greedy if they're up. All emotion. Instead, set rules. Write them down. Commit to them ahead of time. For example, I will sell any position that falls more than 25% from my purchase price unless I have a specific, documented reason to believe the fundamental thesis is still valid. Or, I will take partial profits on any position that doubles. I'll sell half, lock in gains, and let the rest run. These rules remove emotion. You're not deciding in the heat of the moment. You're following your preset rule. At BlackRock, we use stop-loss orders and profit-taking rules constantly. They're part of our risk management discipline, and they work because they execute automatically. No emotional override. Fourth, limit how often you check your portfolio. This might sound counterintuitive, especially coming from someone who spends an hour daily studying markets. But there's a distinction. I'm studying markets and the economy. I'm not obsessively checking my personal portfolio every day. Research shows that the more frequently people check their portfolios, the worse their returns. Why? Because frequent checking triggers emotional reactions. You see red numbers, you feel pain. You see green numbers, you feel greed. And those emotions lead to impulsive decisions. So set a rule. I will check my portfolio once per quarter during my scheduled review. Maybe once per month if I absolutely must. But not daily. Definitely not multiple times per day. Give yourself psychological distance from short-term volatility. Fifth, use target date funds or balanced funds for retirement accounts. These funds automatically adjust their allocation as you age, becoming more conservative as you approach retirement. You don't have to make those tactical decisions. The fund does it for you, based on best practices developed by professionals. Is this the absolute optimal strategy? Maybe not. Could you potentially do better managing it yourself? Possibly. But here's the reality. Most people don't. Most people make mistakes. They get too aggressive when young, or too conservative when they have decades ahead. So for many investors, especially those who don't want to spend significant time on portfolio management, automated solutions deliver better results than self-management with emotional decision-making. Now, let me address a common objection. Larry, isn't automation just being lazy? Isn't it abdicating responsibility? My answer? Automation isn't lazy. Automation is smart. Automation is recognizing that you're human, that you have biases, that you make emotional mistakes, especially during stressful moments. And rather than pretending you're immune to those mistakes, you build systems that protect you from yourself. Some of the most successful investors I know use extensive automation, not because they're lazy, but because they're disciplined. They recognize that willpower is finite, that decision fatigue is real. The best way to make good decisions consistently is to not have to make the decision over and over again. Make it once, systematically, and automate the execution. Think about it this way. I wake up at the same time every day. I exercise every morning. I read the same publications. I have the same breakfast routine. Is that boring? Maybe. But it removes dozens of decisions from my morning. I don't have to decide what time to wake up. I don't have to decide whether to exercise. I don't have to decide what to read. Those decisions are already made, automated into my routine, so I can save my cognitive energy and decision-making capacity for the things that actually matter. Strategic decisions, big picture thinking, responding to unique situations. That's what automation does for your investments. It removes the repetitive, emotional, low-value decisions. so you can focus on the high-value, strategic decisions. What's my overall allocation? What's my risk tolerance? What are my long-term goals? Those are worth spending time on. Should I invest today or wait until tomorrow? Should I check my portfolio again? Should I sell because I'm nervous? Automate those away. Build systems. Remove emotion. Let discipline replace willpower. That's habit number 4. Habit number 5. And this one might surprise you because it's not directly about investing at all. Protect your health and maintain balance. I run one of the most demanding organizations in the world. BlackRock manages over $11 trillion. I have clients on every continent. I deal with governments, central banks, major corporations. The pressure is immense. The stakes are enormous. The demands never stop. And yet, I prioritize balance. I prioritize health. I prioritize time with my family. Why? Because I've learned something fundamental over 50 years. You cannot be a successful, long-term investor if you burn out, if you destroy your health, if you sacrifice the relationships that matter most, if you work yourself into exhaustion. This is a marathon, not a sprint. Investing is about decades, not days. And you need to maintain yourself for the long haul. Let me tell you what this looks like practically in my life. First, I exercise every single day. 1 hour. Non-negotiable. I mentioned this earlier as part of my morning routine, but let me emphasize why it's so critical. Exercise isn't just about physical health, though that matters enormously. It's about mental health, stress management, cognitive function, decision-making quality. When I'm exercising, I'm not thinking about BlackRock. I'm not thinking about markets. I'm present with my body, with my breath, with the movement. And that mental break, that reset, makes me sharper when I return to work, more creative, more capable of handling stress, better able to make complex decisions under pressure. There's extensive research on this. Exercise improves executive function, the cognitive abilities you need for planning, problem-solving, and strategic thinking. It reduces anxiety and depression. It improves sleep quality. All of these things matter enormously for investors. When markets are volatile, when everyone's panicking, the person who's physically and mentally healthy is more likely to stay calm and rational. Second, I prioritize sleep. I wake up early, yes, but I also go to bed early. I aim for 7 to 8 hours every night, and I protect that sleep. I don't stay up late reading emails. I don't let work bleed into my sleep time, because I know that sleep deprivation destroys judgment. When you're tired, you become more emotional, more impulsive, more prone to mistakes. All the things that lead to bad investment decisions. Think about the worst investment decision you ever made. I'll bet you weren't well rested when you made it. Third, I take real vacations. Time away from work, time with my family, time to recharge. Now, I'll be honest, I'm not great at completely unplugging. I still check in, I still stay informed. But I give myself permission to step away from the daily grind, to not be in the office, to not be making constant decisions. And that time away gives me perspective. It reminds me what actually matters. It renews my energy. Some of the best strategic insights I've ever had came during vacations, when my mind was relaxed and not grinding away at problems. Fourth, I maintain relationships outside of work. My wife, my children, close friends. These relationships aren't secondary to my career. They're the foundation of my life. And I invest time in them deliberately. Family dinners, weekends together, conversations that have nothing to do with finance or business. Why does this matter for investing? Because investing is ultimately about life, about building wealth so you can live well, so you can provide for the people you love, so you can have security and freedom. If you're so obsessed with making money that you neglect the relationships that give life meaning, what's the point? I've known plenty of wealthy people who are miserable, who destroyed their marriages chasing returns, who don't know their children because they were always working. That's not success. That's failure with a lot of money attached to it. Fifth, I maintain perspective. I remember what's important and what's not. When markets are volatile, when there's a crisis, when I'm feeling stressed, I remind myself, this too shall pass. Markets always have. The world has survived worse. My job is to make good decisions, to serve our clients well, but not to take on more stress than necessary. This perspective, this ability to not catastrophize, comes from maintaining balance, from having a life outside of work, from prioritizing health and relationships. When your entire identity is wrapped up in your portfolio performance, every market downturn feels like a personal crisis. Every loss feels like a failure. But when you have balance, when you have other sources of meaning and satisfaction, you can weather market volatility with equanimity, with calm. And that calm leads to better decisions. Now, let me address something I hear frequently from younger investors. Larry, I don't have time for all this. I'm trying to build my career. I'm trying to make money. I'll worry about balance later. I'll worry about health when I'm older. And I tell them, that's exactly backwards. That's the recipe for burnout. The time to build healthy habits is now, not later, because later never comes. And if you burn out in your 30s or 40s, if you destroy your health chasing money, you're not going to enjoy the wealth you build. Plus, and this is critical, healthy habits make you a better investor right now. Not despite the time they take, but because of it. Exercise makes you sharper. Sleep makes you better at decisions. Balance gives you perspective. These aren't distractions from investing. They're essential components of investing well. At BlackRock, we've built a culture that values work-life balance. We offer generous parental leave. We encourage people to take their vacations. We promote people who demonstrate balance, not just people who work 80-hour weeks. Why? Because we've learned that balanced people make better decisions. They're more creative. They're less likely to burn out. They stay with us longer. They build better relationships with clients. The people who grind themselves into dust, they make costly mistakes. They leave after a few years. They don't last. So here's my advice. Build these habits now. Exercise regularly. Schedule it. Make it non-negotiable. Find something you enjoy so you'll stick with it. Prioritize sleep. Go to bed at a consistent time. Create a bedtime routine. Protect those 7 to 8 hours. Maintain relationships. Schedule time with family and friends. Be present when you're with them. Don't let work consume everything. Take breaks. Real breaks. Vacations where you actually disconnect and recharge. And protect your mental health. If you're feeling overwhelmed, anxious, burned out, get help. Talk to a therapist. Talk to a trusted friend. Don't suffer in silence. These aren't luxuries. These aren't things you do after you're successful. These are the foundations of success. When you're tempted to skip the gym, to stay up late watching market futures, to cancel plans with family because you want to check your portfolio, remember, successful investing is a marathon. You need to maintain yourself for decades, and that requires discipline about health and balance just as much as it requires discipline about investment decisions. That's habit number 5. Protect your health and maintain balance. Invest in yourself first. All right, 5 habits, 5 daily practices that built BlackRock into an $11 trillion firm. 5 habits that have guided my 50-year career. Let me bring this all together for you. Habit 1. Start your day before the market does. Take control of your morning. Prepare before chaos begins. Habit 2. Dedicate 1 hour daily to continuous learning. Stay a student. Never stop getting better. Habit 3. Conduct quarterly reviews and rebalance systematically. Make discipline automatic. Prevent small problems from becoming disasters. Habit 4. Automate every decision you can. Remove emotion. Build systems that protect you from yourself. Habit 5. Protect your health and maintain balance. This is a marathon. You need to maintain yourself for decades. Now, here's what's beautiful about habits. They compound. At first, waking up early is hard. Reading an hour a day feels like a sacrifice. Quarterly reviews seem tedious. But after weeks, after months, after years, these habits become automatic. They become who you are. They become effortless. And the results compound exponentially. One day of early morning preparation doesn't change your life, but 365 days does. 3,650 days does. 18,250 days, that's 50 years, creates extraordinary results. 1 hour of learning doesn't make you an expert, but 365 hours a year for 10 years, that's 3,650 hours, equivalent to multiple graduate degrees, makes you remarkably knowledgeable. 1 quarterly review doesn't transform your portfolio, but 40 quarterly reviews over 10 years, 80 reviews over 20 years, that systematic discipline compounds into massive wealth preservation and growth. I've been following these 5 habits for 5 decades, and I can tell you with absolute certainty, they work. They worked when I was starting out with nothing. They worked as I built BlackRock from 8 people in a room to a global firm managing $11 trillion. And they'll work for you, whether you're managing $11,000 or $11 million, whether you're 25 years old or 65. Because these habits address the universal challenges of investing: emotion, inconsistency, lack of preparation, reactive decision-making, burnout. And those challenges don't care how much money you have. They affect everyone. But you have to commit. You can't just read this and nod your head and then do nothing. You have to actually build the habits. So here's my challenge to you. Pick 1 habit. Just 1. Don't try to do all 5 at once. That's overwhelming. That's a recipe for failure. Pick the one that resonates most. Maybe it's waking up earlier. Maybe it's dedicating time to learning. Maybe it's setting up automatic investments. Whatever it is, start today. Build that 1 habit over the next 30 days, Make it consistent. Make it automatic. And once it's locked in, once it's part of your routine, add the second habit, then the third, then the fourth, then the fifth. Within 6 months, you can have all 5 habits integrated into your life. And when you do, when these habits are just part of who you are, you'll be a completely different investor. More disciplined, more knowledgeable, more systematic, better prepared for long-term success. At BlackRock, we didn't build $11 trillion overnight. We built it habit by habit, day by day, year by year, over decades. And that's how you'll build your wealth too. Not through luck, not through some secret formula. Through consistent application of sound habits over time. The path is clear. The habits are proven. The only question is, will you commit? Will you build these habits? Will you do the work? Because I promise you, if you do, if you commit to these 5 habits and follow them for years and decades, you're going to build real wealth. Sustainable wealth. The kind of wealth that gives you security, freedom, and peace of mind. That's what successful investing looks like. Not dramatic, not exciting, just disciplined habits, repeated consistently, compounding over time. Start today. Pick one habit. Build it. Your future self will thank you.